Social media is full of people claiming you can make money while you sleep. Buy this course. Follow this system. Build passive income and never work again. But if it's so easy, why isn't everyone rich? Why are the same people who promise effortless income posting daily, sometimes hourly, just to sell you the idea of not working? There's a contradiction buried in the passive income dream. And once you see it, you start to understand what passive income actually is and what it has never been. The promise is everywhere. Scroll for 30 seconds and you'll find someone in front of a rented sports car telling you they make $5,000 a month doing nothing. A course, an app, a system that runs itself. It's an attractive story, especially right now. Trust in traditional career paths has eroded. People watch their parents work for decades only to retire with modest savings. The cost of living has climbed faster than wages in most American cities. So the idea of income that doesn't require trading another hour of your life for another dollar, that idea hits something deep. It taps into a real desire for freedom, time with family, escaping a boss you don't respect, waking up without an alarm clock dictating your entire day. That desire is valid. The problem isn't the dream. The problem is what's being sold as the path to it. Because almost none of what's marketed as passive income is actually passive. And understanding that distinction is where real financial education begins. So let's define this properly. Passive income is money earned from an asset or system that continues generating value with minimal ongoing effort after a significant amount of upfront work, money, time, or skill has already been invested. Read that definition again, because every word in it matters. Minimal ongoing effort, not zero effort. After significant upfront investment, not before it. This is the part influencers conveniently leave out. Every legitimate passive income source you've ever heard of required something substantial before it produced a single dollar passively. A landlord didn't wake up owning a rental property. They saved a down payment for years, researched a market, secured financing, and took on real financial risk. A dividend investor didn't wake up with a portfolio. They spent years contributing money, often sacrificing present spending, before that portfolio grew large enough to produce meaningful income. An author earning royalties spent months or years writing a book that might have failed to sell at all. Passive income is rarely passive at the beginning. It becomes passive later, as a reward for work that already happened. That single distinction destroys most of what's being sold online today. Let's go through the myths directly, because each one is doing real damage to people who don't know better. Myth 1. You can make money while doing nothing. This is the foundation of nearly every passive income pitch, and it's false from the start. Even the most passive income sources, dividend stocks, index funds, require you to first accumulate capital. That capital came from somewhere, usually from active work. There is no version of wealth creation that skips the step where value gets created by someone, somewhere, through effort. Myth 2, you can get rich quickly through passive income. The mathematics of passive income are slow by nature. A dividend portfolio generating meaningful monthly income typically requires years of consistent contributions. A rental property takes time to pay down and appreciate. There are no shortcuts here that don't involve dramatically higher risk. And dramatically higher risk means dramatically higher odds of losing money entirely. Myth 3. Passive income requires no ongoing work at all. Even well-established passive income sources require maintenance. Rental properties need tenant management and repairs. Digital products need updates, customer support, and marketing. Dividend portfolios need periodic rebalancing and tax planning. Minimal effort is not the same as no effort. Anyone telling you otherwise is selling you a fantasy, not a strategy. Myth 4. Anyone can become rich overnight through the right opportunity. This myth survives because survivorship bias makes it look true. You see the rare person who built something fast. You don't see the thousands who tried the identical strategy and failed completely. For every viral success story, there's an invisible graveyard of nearly identical attempts that went nowhere. The strategy wasn't the variable. Timing, market conditions, and substantial luck were. So what does real, legitimate passive income actually look like? Let's go through the genuine sources, the ones built on substance rather than marketing. Dividend stocks. When you own shares in certain companies, they pay you a portion of their profits regularly, often quarterly. Build a portfolio large enough and those payments become meaningful income. The advantage is genuine passivity once built, minimal ongoing work required. The disadvantage is the capital requirement. Generating even $500 a month in dividends typically requires a portfolio in the hundreds of thousands of dollars accumulated over years. Real estate rentals. A property generates monthly rental income that can exceed its carrying costs. The advantage is consistent cash flow and the ability to use leverage to control a large asset with relatively little capital. The disadvantage, and this is critical, is that rental properties require active management. Tenant issues, maintenance, vacancies. It's a business with passive characteristics, not a truly passive asset. Index funds. A simpler, more hands-off version of stock ownership. You're not collecting dividend checks specifically, but the fund's value grows over decades and you can systematically withdraw from it later in life. The advantage is extreme simplicity and historically reliable long-term growth. The disadvantage is that it requires patience measured in decades, not months, and offers no meaningful income until that growth has compounded substantially. Royalties. Musicians, authors, and inventors earn ongoing payments from work they completed once. A song, a book, a patent. The advantage is that, once created, the asset can generate income indefinitely with no further work. The disadvantage is the brutal odds. Most books don't sell. Most songs don't get streamed meaningfully. Most patents never get licensed. The income is passive, but the path to creating something that earns royalties at all is enormously uncertain and competitive. Businesses with systems. A business that operates through employees, automated processes, and management systems, rather than requiring the owner's daily involvement. The advantage is significant income potential, often far beyond other passive sources. The disadvantage is that building those systems typically requires years of intensely active work, often involving significant financial risk, before the business can run without its founder. Digital products, online courses, templates, software, and similar products that can be sold repeatedly after being created once. The advantage is low distribution costs and global reach. The disadvantage is saturation. The market is now flooded with digital products, and most fail to generate meaningful income because audience building and marketing require ongoing, very active effort, the part most creators don't mention. Every single one of these sources shares the same pattern. Real upfront cost, real upfront time, real upfront risk, followed, eventually sometimes years later, by income requiring less effort to maintain than it took to build. Here's how genuinely wealthy people actually approach this. And it looks almost nothing like the social media version. They don't chase passive income directly. They build assets and treat the resulting income as a natural byproduct of ownership, not the primary goal of some isolated side hustle. A wealthy entrepreneur doesn't think, I need passive income. They think, I'm going to build a company that creates real value. Years later, if that company succeeds, they may step back from daily operations while it continues generating income through the systems and people they put in place. The passivity is a consequence of the asset's quality, not a strategy pursued for its own sake. A wealthy investor doesn't think, I need dividend income. They think, I'm going to consistently acquire ownership stakes in productive businesses over decades. The dividend checks that eventually arrive are a result of patient capital accumulation, not a quick scheme they discovered. This is the mental shift that almost never appears in passive income marketing. Wealthy people focus overwhelmingly on building and acquiring assets. The passive income is what those assets eventually produce, not the goal pursued directly, and never the starting point. Here is the part of this conversation that almost nobody wants to say out loud because it doesn't sell courses. Passive income is delayed income. It is the financial result of work, risk, and capital that were deployed long before the income started flowing. The landlord's monthly rent check is the delayed result of years of saved capital and active property management. The dividend investor's quarterly payment is the delayed result of a decade of consistent, disciplined contributions. The author's royalty check is the delayed result of months of difficult, uncertain writing with no guarantee of ever selling a single copy. There is no version of this that skips the delay. The people who seem to have discovered some loophole around it are almost always either further along in a long process than their content suggests, or they are selling you the dream itself as their actual product, which is, ironically, the only truly fast and scalable income stream in the entire passive income economy. So can passive income actually change your life? Yes, genuinely yes. But the honest answer requires nuance that doesn't fit neatly into a 30-second video. It can supplement your income meaningfully over time. It can eventually replace a portion or even all of your active income, but usually only after years of consistent building. It can provide real security, real optionality, and real freedom. But it is a long-term outcome, not a near-term fix for financial stress. What it cannot do is replace the absence of a financial plan. It cannot substitute for savings discipline. It cannot bypass the basic mathematics of accumulation versus consumption. And it almost never works as a rescue plan for someone in immediate financial difficulty. Because by definition, it takes time to build, and immediate problems need immediate solutions. The realistic promise of passive income is not stop working forever, starting now. It's build deliberately today, so that years from now your money and your assets are doing more of the work than you are. That promise is less exciting than what gets sold online. It is also far more honest. And it is achievable by ordinary people who understand what they're actually signing up for. Passive income is not about making money without effort. It never was, and it never will be. It is about building assets through real work, real capital, and real time that continue producing value long after the initial effort is done. The income feels passive because the work has already happened. It is the financial echo of decisions made years earlier. The people who actually achieve it are not the ones searching for a shortcut around effort. They are the ones who made peace with the effort, did it anyway, and let time eventually deliver the result they were patient enough to wait for. That's the truth. It's less flashy than the version sold to you online, but it's the version that actually works. Passive income depends entirely on assets that grow in value or produce income over time. And the most widely used asset for exactly that purpose is something most people use every day without truly understanding it: the stock market. Why does it go up? Why does it crash? And what is actually happening when you buy a single share? That's exactly what we're breaking down next.